Parekh is with us, founder and CIO at Sohum Asset Managers. Sanjay, good afternoon. Good to have you on the show as always. We played that soundbite of Ramdevji earlier. He was saying we're close to the bottom, 500,000 points. I don't know. And actually, you're starting to hear more and more of those voices. Samir Arora was on a few days back, I think about a week and a half back it was. And he was talking about close to the bottom again. I mean, a few percentage points, no one can tell. And I think those few percentage points have happened since we spoke with him. What is your sense, Sanjay? Time to... And of course, the question always is for mid and small caps, large caps. So just your view now. Sanjay, you'll have to unmute yourself, please.
Yeah, sorry. So, good afternoon. So, I agree with them. I mean, I'm talking about Nifty now in terms of earnings yield versus debt yield, the gap which was higher, on FY26 now, we had an earnings yield of, let's say, 18.5 times on 26, which is 5.3% yield, 10-year is at 6.7. So we are at 1.3% gap, which is absolutely a reasonable level and an attractive level to buy in. You take on broadly, price earning, absolute price earning also now it's getting reasonable. As we move to 27, it gets further comfortable. So, and now we've also seen time correction. So, and the best part is now slowly and steadily we are seeing some recovery. So the PMI numbers that we've seen in some of the heat map indicators, a little bit of better credit growth. So I'm sure the government spend will have impact in February, March and ahead. And as slowly and steadily we recover, certainly, we strongly believe that for Nifty larger cap products, this is a time to buy in, and one should not now try to get exactly at the bottom, I mean, it's always humbling, right? We were positive 3-4% ahead of the current market, but it is down 4%, and that's a reality. So in the near term, what flows would do, we don't know. But fundamentally, our conviction from the time we've started our fund is the highest to buy into products which are large cap based,
Sanjay, so let's go with the thesis or assumption that, we're close to the bottom and markets will see a bit of a recovery, large cap. Now, there's one, there are some who believe that when we get this rebound, it'll suck more people in. And then there is another gut-wrenching correction which, awaits us, which could take the Nifty even lower, maybe down to levels of about 19,000, 20,000. Do you think just over the medium term, near term, fine, there is a recovery. But do you think there could be another correction which awaits us?
No, I don't think so. So, again, the starting point are balance sheets. I've seen the banking sector for last 15 years. I've seen 10 years it took to clean up the NPAs, You take all the balance sheets, you take banking balance sheet, SBI and net NPA is the lowest. We can see inch up in overall NPAs, but it's not any major leg up. You see corporate balance sheet at the lowest leverage. Household balance sheet, of course, at the top end is good. In the mid end, is need to support them at the lower end of 70, 80 crore people. And then, the gold, the wealth effect of gold is not discussed. But if you take the negative effect of equity versus the impact of positive wealth effect of gold, it actually neutralizes because Indians are full of gold across balance sheets, across the board. So that has helped. And, so all, and even the fiscal deficit, we have an operating leverage there. We saw that slowly and steadily we will reduce our fiscal deficit. And RBI, you saw when the intention was to give back liquidity, durable liquidity through swaps or injecting VRR through VRRs or direct infusion, all of them has happened. So now you're able to see the intent also that RBI and government is wanting that economy should recover and supportive of growth. And this is exactly the combination where there is uncertainty, you have near-term pain, there is disbelief, and as things get better, markets can actually move up, and then it might be a little late for one to buy in. The only argument where I think is a relative valuation, where still emerging market is at very low valuations, China is also at low valuation, and we are still at 18.5 times. So there could be some more time correction as growth recovers, but we are very, very confident and comfortable to buy into Nifty-based products from current levels.
All right. Hi, Sanjay. Good afternoon and good to see you. When, as you say, the market ultimately, the prices are the ultimate king. You all believe that the time is good. And both, you have the double engine that's firing. RBI is seeming more growth oriented. And the government's measures as well will support growth earnings for the coming quarters. That said, two factors I wanted to get out of you. One is, what is your client behavior? Are they getting nervous? Are they willing to put out more money? You're sitting on around 5% of cash. That's point number one. And point number two is, in terms of sectors that are high beta, metals as well as real estate. And I'm looking at it, I think real estate is something that you like at current reckoning. The sector, the stocks have pulled back 20-30% as well. Your view on it. So tell us both, client behavior as well as real estate theme. Go ahead.
Yeah, so clients, we have family offices, large HNIs. I mean, nobody likes wealth erosion to start with. But I think there's no panic. In fact, most of the queries we get is, should we deploy? What should be the pace of deployment? Our distributors are also very, very mature. So, we try to give our best view and even telling them that, you can certainly now not wait. You can deploy 50-60% and grow gradually for the next 2-3 months. But now there's no need to spread out big way because the levels are very good now. So that's on the client side. We don't see any panic there. Especially in the HNI and super HNI and family offices. That's a fun thing. Second is, our cash levels certainly is 5%. We will look to deploy. And our price earning, we're comfortable with the price earning of a portfolio today at 13 times, a little over 13 times on 26, with growth of 18-19% and ROE also of 17%. So our portfolio has a cyclical tilt, and we did see a near-term underperformance compared to Nifty TRI, which is our benchmark. But we were very, very confident, that even in some of the metal stocks that we own, real estate may take some more pain, but overall, we think there also we own DLF, where we think the longer-term addressable opportunity is pretty large, and we would hold on to them. So that's where we are. So bottom up now, we are taking a view on larger caps that we like. For sure, some of them have become very, very attractive across financials, bank, transportation, and then telecom. And then middle and small cap, we will be very, very selective, and our margin of safety will be higher, which has always been the case.
Okay, got it. So, Sanjay, in terms of your list of overweight, so basically sectors that have a fair amount of representation already in your fund, banking and financial services for sure, IT, you also have a large amount of, I think, telecom in the portfolio, almost 6.5% or so.
Yes.
What about consumer? And there's capital goods as well. I saw that in the fact sheet. What about a sense on consumer? Would you be betting on any kind of, recovery in consumption, whether it's urban, whether it's rural? And would you look to play that through any way, directly through FMCG, or maybe indirectly as well, through other sort of consumption proxies?
Right. So, we have taken sector bets, and some of it is aggressive. So, our FMCG weight is 0 now for more than 1.5 years. Our oil and gas weight is 0. So we do take such bets. We are overweight on, as you said, capital goods, financials, overall financials. Telecom is a big bet that we've taken, both through Indus and Bharti. And then, of course, capital goods also we have overweight through Larsen & Toubro and one or two mid-cap names. So we are continuing with the IT. We are underweight. It did hurt us in the mid last few months, but after this correction, we are okay. So, but over a 3-year period, you still see IT is underperformed. So we would want to continue to remain underweight there, and that would be our view right now to have this sector view and go bottom up on each of the stocks that we like.
Sanjay, thank you very much for that. Today there is